Hey, what's up, everybody? It is Friday, February 14th. Happy Valentine's Day to everybody. Happy Valentine's Day. All right, let's go over the market. Let me talk about sentiment for a second. You know, each week I go over the AAII Weekly Sentiment Survey that's put out by the American Association of Individual Investors. They have a nice survey that they post online showing the percentages of bulls, neutrals, and bears. Some of you may recall that, you know, I mentioned this a lot last year when the level of neutrals was sustained at a very high level. I mean, these people, they watched the market go up, they watched it go up, they watched it go up, and I said, eventually, they're going to jump off the fence. They're going to jump off the fence at the highs. And we did see that recently. But in the latest week, which covers the week ending on Wednesday, February 12th, we saw bullish sentiment shoot back up again. We saw bearish sentiment come way down. And what was interesting was that the neutrals, which were low now for the past, month, they went back up a little bit. Now, the reason why I find this curious is because all last year, those people who were sitting on the fence, they were wrong. I mean, they waited and they waited and they waited and they finally jumped in at the very top. And this behavior was, at least for me, it was totally expected. Like I kept saying, that's what we're going to see. And when we see that, it may not be the exact top at that moment, but it is the environment of a top, because you have these people who watch and they wait, and finally when everything looks perfect to them, they jump in. But meanwhile, the market's up like 25% or something like that. But in this latest week, when we had the rally, and it was an explosive rally to new highs, remember we had a little correction, and then there was some headlines that researchers were working on a coronavirus vaccine, and the market shot way up to new highs. And you would think that you'd see the neutral level come down further as they jumped in. But this time it went up. And I interpret that as people who are a little bit more savvy and not buying into the latest new high. So we're looking at the S&P level around 3380, 3385, let's call it. That might be a level that is kind of a top for now, if not for a longer period. The other thing, I like to look at anything that is going to give me a sense about the demand in the economy, the vibrancy, the strength of the economy, right? I talk a lot about, for example, bank credit. I follow bank credit trends very closely every week. I follow the petroleum markets because they are also very sensitive to economic activity. Look at gasoline demand, looking at distillate demand, looking at inventory, seeing what's going on there, seeing what's going on with exports. Well, in the latest week, one of the things I look at is the level of foreign currency holdings by the Federal Reserve. Now, the Fed is not active itself in the Forex market. It hasn't been for many decades, okay? I remember back in the 80s, central banks were intervening all the time. But that doesn't really happen too much anymore, direct intervention in the Forex market. But there are fluctuations in the Fed's foreign currency holdings, and that usually correlates pretty closely to export trends. And if you think about it, it makes sense. I mean, companies that export, U.S. companies that export, that receive payment in foreign currency, what happens? They deposit that foreign currency in their bank. They ask the bank to convert it into dollars. The currency eventually goes to the Fed because the bank then changes it with the Fed, exchanges it with the Fed for dollars. So the Fed ends up holding it. So it's kind of a pretty good gauge as to export activity. It correlates pretty closely. And one of the things I noticed in the latest report, and this comes out every week in the Fed's H.4.1 release, was that we had a sharp decline in foreign currency holdings in the latest week ending February 12th. Now, to me, that suggests some sort of a hit to exports. And again, I'm trying to ascertain, I'm trying to, sort of get a reading on demand, particularly, we hear a lot of talk about China, we hear a lot of talk about coronavirus. If there's something that would give us an indication, a lot of this analytical stuff, you got to be like a detective. You got to look for evidence. You got to look for things that will cue you as to what is going on. And I think this could be one thing. I mean, we don't know the true story of what's going on in China other than, we are reading the headlines about these cases of coronavirus multiplying and doubling and tripling. But we need to understand how it's impacting economic activity. And I'm looking at this decline in foreign currency holdings. I equate that to a drop in U.S. exports. Could be petroleum, all right? That's a big export to China. And so that would be some kind of an indication. Apart from that, so we have sentiment now at bullish readings. We have indications of perhaps slowing exports, slowing demand. And, the other factors, the slowdown in credit growth, the unemployment benefits, which I mentioned, or I have been mentioning, which are trending higher. You start to put all these things together, and while it's not giving a picture of any sort of a contraction, it is giving a picture of a slowdown. And of course, let's not forget the fiscal situation, which I've been talking about now for a number of weeks, where you see the flows, tax flows, spending flows, starting to reach or heading towards an inflection point where we have tax flows exceeding the spending flows. Now that, in my opinion, would be the signal that we are in a shifting environment, that the supportive fiscal environment that has held the economy up, that has held the market up, that is shifting now to one where you're losing that support. So we got to track this. I'm tracking this every day. Remember, I get the data, and you can get the data every day too. That's available to the public. That's the daily Treasury statement. If you don't understand how to make any sense out of that, you should go to my website, pitbulleconomics.com, and get the course. Get my course for $99, Understanding the Daily Treasury Statement. Believe me, it is an amazing resource. It is free to the public, available to the public. Nobody looks at that stuff, and if they do, they probably don't know how to, take the correct information off of there. My video course teaches you what to look at, how to do your own simple calculations to know what's going on. It's really cool because it's like looking at the checkbook of the United States government every single day. All the deposits, all the withdrawals. You're talking about billions, tens of billions, hundreds of billions, trillions sloshing back and forth. It is a fantastic resource. So yeah, that's where we are. Just let me add into this oil back up above 52. I am taking a small short position over here at these levels. Now we were long at the low end. Commercials have been strong buyers down on the 50 handle. I suspect they may be selling up here. We're going to see that information from the CFTC's weekly Commitment of Traders report, which comes out, by the way, today, Friday. Anyway, that's it. Go to my website. Remember, I am the only one who has an applied approach to MMT. Use the concepts and understandings of MMT to trade and invest profitably in the market. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. The link is right here below in the description. Click on the link and get your 30-day free trial. Have a great day. Happy Valentine's Day to everybody. See you on Monday. Bye-bye.